Hey friends, welcome back to the Wealth Expedition. Today, I'm going to answer a question that I used to get a lot as a financial advisor, and that is, should I use a stop loss? A stop loss is a safety net. It's a way of protecting from big losses. But there's also an alternative risk that it introduces. Stop losses are deceptively simple, and most investors use them in ways that actually sabotage their long-term compounding, whether they recognize it or not, and probably most of them don't recognize it. Today, I'm going to break down when stop losses help, when they hurt, and why tight stop losses, especially on broad market indexes, can actually make long-term returns worse. So first things first, what is a stop loss? It's an instruction to automatically sell an investment once it hits a certain price below the current market price. So if you own, let's say, an S&P 500 ETF, and let's say the current price is $700. If you set a stop loss 8% below that number, then you're telling your broker to sell if the price drops to around $644. The tactic itself is simple. The idea is that you limit downside risk, but the reality of what is actually accomplished for you is more nuanced. To understand stop losses properly, we have to think in terms of three things that drive investment performance: position size, win rate, which is how often your strategy wins, and the payoff ratio. This describes how big your wins are relative to your losses. The way that someone designs their stop loss strategy affects both the win rate and the payoff ratio, often in opposite directions. So here's a common example to put this in concrete terms. Imagine that you agree to a strategy where you take profits at 30%, and you put your stop loss at just 1% below the current price. What that means is that if the asset drops 1% from its current value, you sell and take a 1% loss. If it goes up, however, you don't exit the position until you've gained 30% from that starting point. So naturally, the payoff ratio in this case is 30-1. That sounds incredible on paper, right? You make 30% when you're right, but only lose 1% when you're wrong. But the payoff ratio only matters in the context of the win rate. With such a tight stop loss on the S&P 500, in this case, you might only win 3-4% of the time. That means frequent small losses and very, very rare wins. And that can leave you with an average annual return, maybe something like 1% or even worse. That's not good risk management. That's actually a terrible strategy. So that brings us to the question, is there a stop loss level that reduces risk, helps automate decisions, and doesn't seriously harm long-term returns? Well, some research may indicate that there is. Research from data spanning from 2000 to 2005, which includes the tech bubble and the recovery, suggests that there might be a sweet spot. This has only been tested within this range. It hasn't been tested out of sample. So according to this study, it suggests that there might be a meaningful relationship for setting stop orders, particularly on the S&P 500. Let's talk about pullbacks in the market. A pullback is down 5 to 10%, and this is normal, even in the best of market environments. These are not signals of disaster. They often happen quickly, and they're just the cost of equity ownership. This is why very tight stop losses are so dangerous and ineffective. They get hit by ordinary market noise, not real trend chases. So if 5 to 10% pullbacks are so common, what does that mean for stop loss design? Well, what this study found was that approximately an 8% stop loss on the S&P 500 is wide enough to survive ordinary volatility much of the time, but it's still narrow enough to improve the likelihood of missing the worst part of a true bear market. So for example, if the index is 700, an 8% stop sits around 644. If the market rises to 730 and then drops 8%, your stop wouldn't be triggered because only a drop below 644 would trigger that stop. So paired with a take profit rule of, let's say, 30%, this type of setup doesn't necessarily destroy long-term returns. In some historical periods, it could even improve them. But here's where most stop loss strategies actually fail. It's not the stop loss itself, it's what happens after you get out. So most declines of 8% are short-lived. Some recover in weeks, others take a few months, but Too many investors freeze and wait for the news to get better or to get confirmation that we've hit a trough in the market. And by the time that they re-enter the market is already higher and they've locked in a loss that they didn't need to. That's the biggest problem that stop losses create. It's psychological timing errors. Investors often have an automated strategy for getting out, but not an equally automated and logic-driven strategy for getting back in. And thus, they can't consistently apply a strategy. And consistency is key. And then emotional investing just takes over, which destroys long-term returns. So what am I saying? Stop losses aren't inherently bad. They're just misused. They can actually be helpful. Here's who they can make sense for. Investors who want smoother short-term outcomes, investors who might be hedging a perceived late cycle risk in the market, or those who are investing for opportunity capital with shorter time horizons like 3 to 5 years. But they're definitely not one size fits all. And if you do use stop losses, you absolutely must have a rules-based re-entry plan. Otherwise, they just become traps that actually increase your risk of not achieving the financial goals that you've set. For most long-term investors, tight stop losses are a big mistake. They reduce win rates, they interrupt compounding, and they increase the odds of selling low and buying back higher. But a wider stop, aligning with normal volatility, can be a thoughtful tool if it's used with discipline and with clearly defined rules for getting back in. Because the bottom line is that the stock market requires accepting discomfort. That's just a part of it. And avoiding normal downside risk often means giving up extraordinary upside. A lot of the best market days come very close in proximity to the worst market days. And no stop loss strategy changes that fundamental truth. If you want help building your personal investment strategy in a way which brings clarity to an otherwise foggy subject, I'd love to see you over at the Wealth Expedition, a membership platform for group financial guidance. This is far different than having a financial advisor that you pay thousands to every year. It's low-cost guidance for doing things yourself, with personal financial planning available if you want one-on-one advice. I invite you to check it out with the link below this video. And if you enjoyed the content, don't forget to like and subscribe so you can continue to micro-learn strategies that lead to financial independence. Thanks for watching, and I'll see you next time.